Many people often confuse emergency funds with insurance, believing they serve the same financial purpose. However, this misunderstanding can be financially dangerous. While both are critical pillars of financial stability and risk management, emergency funds and insurance differ significantly in structure, purpose, usage, and coverage. Conflating the two could lead to being underprepared in a real crisis. Emergency funds are about liquidity and immediate access, while insurance is about transferring financial risk to a third party. This video will clarify these distinctions by outlining the top 10 reasons why emergency funds and insurance are not interchangeable. Understanding these differences will help you build a more resilient financial foundation, ensuring that you are protected both in the short and long term. 1. Purpose. Insurance transfers risk. Emergency funds manage liquidity. At the core, insurance is designed to transfer specific financial risks to an insurance company in exchange for a premium. It is a contractual promise that provides compensation for loss, damage, or liability under agreed conditions. Emergency funds, on the other hand, do not involve risk transfer but focus on liquidity management, having accessible cash for unforeseen expenses such as job loss or sudden repairs. This fundamental purpose sets the tone for how each functions within a personal finance plan. Relying on insurance to provide liquidity or on emergency funds to cover major losses can leave gaps in coverage. 2. Coverage scope. Insurance is event-specific, emergency funds are flexible. Insurance is tailored to cover specific risks like health emergencies, car accidents, home damage, or death, depending on the policy type. It is reactive to defined perils and pays out under strict conditions. In contrast, emergency funds are broad in scope and can be used for virtually any personal financial disruption, including job loss, unexpected travel, or household emergencies. This flexibility means that emergency funds serve as a financial catch-all, while insurance is limited to its contractually agreed parameters. Relying on insurance without a backup fund can leave you exposed to events outside the policy's coverage. 3. Accessibility. Emergency funds are immediate, insurance takes time. One of the most practical differences is how quickly each resource can be accessed. Emergency funds are usually stored in high-yield savings accounts or money market accounts and are available instantly or within a day. Insurance, however, requires you to file a claim, provide documentation, and wait for approval, often days or even weeks. In a true financial emergency, time is critical. Whether it's needing to fix your car to get to work or covering rent after a layoff, immediate access to cash can make all the difference, something insurance cannot always provide. 4. Ownership. Emergency funds are your money, insurance is a service. Emergency funds are fully owned by you. You control the amount, when to use it, and how to replenish it. With insurance, you are essentially renting a service. You pay premiums for the right to claim future benefits, but you never own those premiums. If no covered event occurs, you don't get that money back, except in rare policies with cash value components. Emergency funds are an asset on your balance sheet, while insurance is a liability in the form of ongoing payments. This ownership dynamic plays a major role in long-term financial planning. 5. Financial strategy. Emergency funds are proactive, insurance is reactive. Emergency funds are a proactive financial tool. You build them in anticipation of the unknown, aiming to self-insure small to moderate disruptions. Insurance, on the other hand, is reactive. It only comes into play after something bad has already happened and a claim is made. Insurance is vital for catastrophic risk, but your emergency fund is your first line of defense. This strategic difference highlights the importance of having both. A well-funded emergency account can cover your deductible in a health or auto claim, making the two tools complementary but not interchangeable. 6. Cost structure. Emergency funds require discipline, insurance requires ongoing premiums. Building an emergency fund requires budgeting discipline, delayed gratification, and consistent saving. There's no automatic mechanism other than your own habits. Insurance, by contrast, requires regular payments, premiums, which are mandatory if you want to keep coverage. The cost of insurance may also increase based on age, risk profile, or usage, whereas your emergency fund only grows or shrinks based on your savings behavior and needs. This difference in cost structure means that emergency funds reward discipline and independence, while insurance comes with ongoing, externally controlled financial obligations. 7. Risk tolerance. Emergency funds handle predictable risks. Insurance handles catastrophic ones. Emergency funds are best suited for predictable but uncertain life events, such as a job loss, unexpected travel, or minor medical costs. These risks are likely to occur at some point, but usually don't financially devastate you. Insurance is essential for low-probability but high-impact risks, hospitalizations, lawsuits, fire damage, or death, that would cripple your finances without coverage. This difference in risk type is crucial. You can self-fund the small stuff with your emergency reserve, but you should never attempt to self-fund a six-figure medical bill or home rebuild without insurance. 8. Emotional impact. Emergency funds offer peace of mind. Insurance offers relief after a crisis. Knowing you have accessible cash on hand can reduce anxiety and help you sleep better at night. Emergency funds give you confidence to face job uncertainty, family obligations, or economic downturns. Insurance, in contrast, provides emotional relief after a major crisis has occurred. When a claim is successfully paid, it prevents financial ruin but doesn't necessarily reduce day-to-day anxiety unless an event happens. In this way, emergency funds act as a buffer for life's everyday surprises, while insurance is a net that catches you when you fall hard. 9. Customization. Insurance is pre-designed. Emergency funds are fully tailored. Insurance products come with set terms, deductibles, exclusions, and coverage limits defined by the provider. While you can choose policy amounts and riders, you operate within someone else's framework. Emergency funds, on the other hand, are entirely customizable based on your lifestyle, income, dependents, and financial goals. You choose the amount, often 3 to 6 months of living expenses, or even more depending on your comfort level. This complete flexibility makes emergency funds a personal financial tool, while insurance is more of a standardized contract. 10. Life cycle importance. Emergency funds are essential early. Insurance becomes critical with wealth. Early in your financial journey, building an emergency fund should be a top priority. It prevents credit card debt, helps you weather career uncertainty, and covers basic crises. As your wealth grows, insurance becomes increasingly vital, especially life insurance if you have dependents, or liability insurance to protect your assets. The more you have to lose, the more insurance plays a critical role. Thus, emergency funds support your financial launch, while insurance preserves your financial legacy. They serve different stages of wealth building and are both essential at different levels of financial maturity. While both emergency funds and insurance are vital elements of sound financial planning, they serve distinctly different roles and should never be viewed as substitutes for one another. Emergency funds provide liquidity and psychological stability for everyday surprises and short-term needs, while insurance shields you from catastrophic losses you cannot afford to self-insure. Understanding their unique functions allows you to prepare strategically for a wide range of financial risks. Together, they form a two-pronged approach, one offering immediate access to funds when life throws a curveball, and the other providing long-term protection against serious setbacks. In an unpredictable world, having both is not just smart, it's essential for true financial resilience.